Welcome to the daily update, where I'll go over the action in the market for Thursday, January 30th, and we'll see how things look for Friday, January 31st. Had a pretty solid up day. There was a little bit of a scare near the end of the day that I'll talk about, but the market quickly recovered and didn't close at the best levels of the day, but had a pretty solid up day. The weakness that we were seeing after Wednesday that was causing a little bit of concern, it seems to be improving. The momentum is showing a real improvement there. We're still not trending because we've got the ADX just kind of going sideways below 20 and below its moving average, but we're positive. The green line is still above the red line. So we're still positive in the short, intermediate, and long term with our trends. And Apple came out with their earnings after the close. They're up about 3% the last time I checked before I started recording. And the futures are up about a third of a percent. Again, this is many hours before the market opens. So at least the atmosphere appears to be positive. We're coming into the last trading day of January, and this can be kind of a useful tool because usually when January has a positive month, the rest of the year ends up being positive as well. Now, there's always exceptions to that. We look at that more on a historical and seasonal basis, and it looks like we're going to have a positive January. So that also suggests that things could be positive, but there's a lot of changes going on right now. Executive orders, confirmations, geopolitical, domestic events all over the place. And any one of those can come in and have an impact on what's happening in the markets. We're keeping a close eye on interest rates. In fact, I have another chart that I'll show you later on that shows what I'm watching during the day. So let's go back and talk about what happened. We had a higher open and prices got above R1. R1 was at 6,064. And then we declined down to the daily pivot at 6,038. And the unchanged level and the daily pivot were pretty much on top of each other. Then we rose back to R1 and then we pulled back a little bit. Didn't get quite down. It was more of a retracement type of thing. And then we rose above R1, but we didn't quite get up to, it should be R2, not S2, 6,088. And then some comments came out by President Trump concerning the tariffs. Now, again, if you go back through American history, up until about 1913, which is when the income tax was created, only for the rich people and only for a short period of time, and only because we're coming out of a crisis that happened in, I believe it was 1907. Now it's become a way of life and totally changed things. But tariffs are how the U.S. brought income in. And if you go back, if depending on, I teach history, I teach political science, I have a real interest in both of those things too. Where when the country was first founded, the federal government was pretty much tasked with protecting us. And that was kind of their big job. They didn't want it to be really big. We just broke away from a king who told us what to do, even though he didn't live here, all that stuff. And so this is kind of a way of reverting back to what historically we did up until 110, 11 years ago. So, but this is causing some fears in the market. What's that going to do to import exports? What's that going to do? So whenever these comments are made, it's going to have some kind of a reaction. And typically, because it's something that hasn't been done in over 100 years, that might be more of a negative reaction. But and I thought it was, when I was watching things, I thought it was a sell program coming into the market and computers that, okay, when these criteria are met, start dumping. And if it's a big player and there's millions of shares with billions of dollars, that can really drive the index either up or down. In this case, I thought it was a sell program. Then I checked the news and saw up President Trump had made some comments about the tariffs. But then we bounced right back up and we closed above R1. So we were up 0.53% on above average volume. As I said, we're still positive in the short, intermediate, and long term. If there's a concern right now, it's that, first of all, the Swenlin trading oscillator that I'll show you, it's going in different directions between price and volume, and that's been flashing now for about a week. And it's a lack of negative things because I look at so many different things and I use a consensus approach. I don't focus on just one chart. I have other charts that have more of an impact on the conclusions that I make than other charts. But I try to gather as much information as possible to reach the consensus approach that I use. And it's when there's very little to nothing that's negative on the negative side when I get to the end of the video, that's when I get a little bit concerned. But again, we follow price. Price is the ultimate indicator. And we can put all the moving averages and oscillators and studies on price that we want, but we have to follow what price is actually doing. And it held up pretty well in Thursday's session. All right, so some comments. Apple is up 3% after their earnings are released. That's just when I checked this. It's probably very different from the time that I'm saying this and when you might actually be watching this video, and it's many hours after that. And then this is when I talk about there was a dip and then a quick recovery late afternoon when President Trump said that he will impose the 25% tariffs on Canada and Mexico beginning Saturday. That's February 1st, due to immigration issues, trade deficits, and fentanyl. And that's what he's using to say, okay, we need to do this because we need to get more control over these things that have been happening in the US. And because it's new, because it's different, because there's pretty much nobody left that lived under that type of an approach before. In fact, there probably isn't. They would be 150 years old now. It's seen as somewhat threatening because it's changing the status quo here. And small caps, now we have two indexes that we follow for the small caps. One is the S&P 600. That's at its 50-day moving average, where the other, the Russell 2000 small cap index, it's slightly below its 50-day moving average. So even though they were up over 1% and had a pretty good day, they still have not broken above that resistance level. On a short-term basis, one of our short-term indicators that measures momentum, the Williams percent R, it's starting to get extreme again. The stochastics are turning back up. And then on a momentum basis, we have the short-term slope oscillator that is still extreme. Intermediate term, the Sean trend meter, the PMO studies, and one of our smart money indicators, the Chaikin oscillator. And I'll go through and show you charts of all these things. Now, this could be a negative, but I just kind of treat this as an outside type of information source. It's a thing called the mass index, and I'll show you the chart later on. And it has three criteria to be triggered. Well, those three criteria have been triggered, and whatever is happening that created those criteria to be fulfilled, this tries to anticipate that things are going to reverse after that. And that's been flashing now for a few days. And then the Fed did leave rates unchanged. They're still thinking that a soft landing is possible. The stock market still thinks that, which means we're not going to go into a recession necessarily. And as I keep saying in the videos, I look at a bunch of different charts and it's you can make a case for a recession or that things are going to really turn down. You can make a case that things are going to stay pretty good. I just go day by day and analyze things and just say, okay, how do things look right now? I don't forecast looking out. I don't try to project out. I, maybe I just that's a skill that I've never really been able to develop with any kind of consistent success, where I just evaluate things on a day in and day out basis. That's been quite successful. And then just saying, okay, things are changing in this area, so then we make any kind of modifications to our stance and what we're doing right now in the market. But then the Fed is still looking at inflation being stronger, um, at least increasing going forward from here. And then the dollar was up, interest rates were down. We're dealing with that 4.5% level with the 10-year yield. And that's an intraday chart that I'll show you later on because I've been really watching that. Or after Wednesday, we were at 4.56%. If we can break under that 4.5% level, that might really give some good support to stocks. And then sentiment is neutral. We're at 48 where we had been at 46. So we went from neutral to neutral. Once we tick above 45, we're in neutral territory. So we're not necessarily extreme in that aspect either. And we are improving because overall sentiment has been going up, but we're not extreme positive. That will happen if we get up to 75 or so. We're still not trending as measured by our average directional movement or ADX indicator. But we're positive because the green line is above the red line. We're below the moving average. We're below 20. Because of the update, and we were looking fairly solid under the surface, we saw some improvements coming into the market. Our bias is positive. I'm still keeping our momentum at mixed to positive because we're not really trending right now. We're not really, there's not an awful lot of conviction happening. Okay, so the economic reports that came out, this was the first time we saw this number for the fourth quarter of 2024, and it came in as expected at the headline level. It came in at 2.3%. They thought it would come in at 2.3%. Now that is down from 3.1%. The takeaway here is that the number is positive. If we go to negative GDP for 2 quarters in a row, that's part of the definitions of a recession. And so this is still looking good for right now. Now we'll get additional readings to this number for the next couple of months until we get the first quarter of 2025 coming out. And then the deflator actually came in weaker than expected. This is the inflation component of GDP. It came in at 2.2%. They expected it to be at 2.4%, but it was up from the 1.9% that came out last quarter. Weekly initial jobless claims came in weaker than expected, 207,000. That's still showing that the employment arena is solid right now. People are not getting laid off. I'll have a chart to show you of that. They expected 221,000, and last week it was 223,000. So that's a drop. Continuing claims are also going down. Last time it was 1.9 million. This time it was 1.858 million. So that's also suggesting that the employment situation is holding up. Not what you would see if you're getting ready to go into a recession. But then a week from now, we'll also be getting the employment situation report. Pending home sales were down 5.5%. They expected them to be up 0.8%. Last time they were up 1.6%. Okay, so here is real GDP with the deflator. They put both of them on here. And this is a quarter over quarter change where we're coming down a little bit since it was a little bit weaker with the blue line, but we're going up just a little bit with the yellow line, which is the inflation component. And year over year personal consumption, okay, getting ready for that big old Super Bowl, got to consume things there. That's increasing and above zero. Net exports, it's going up here, which means that it's less negative currently. Real GDP year over year is going down, so we are seeing some slowdown that way, but it's positive. The year over year pending home sales are now looking negative, but on a month over month basis, they're also looking negative, but not showing as big of a drop right now from what we were seeing before. Weekly jobless claims went down in the reading, starting to go down with the 4 week moving average. That just means fewer people are filing for first time unemployment. Also, the moving average here is still going up, but we did drop down with the continuing claims. This is the second week onward. People that are having a little more difficult time finding a new job. And then I put them here together with the latest reading on unemployment, where we have in red are the initial claims and blue are the continuing claims, just to kind of give this a little bit of perspective. And then Isabel Net here, this is the net bullish sentiment. And I have a version of this that I'll show later on. It's the individual investors. This goes back a lot further than the chart that I show, where we had come down and we were looking quite negative, and it really bounced back up in the latest reading, but not necessarily extreme right now. If we get above this one level, we're coming in at 0.21 right now. That's when it starts to get a little bit exuberant to the upside there. And I'm glad I'm not the only one that makes typos here, and I make mistakes all the time. But this chart says a positive January is a good thing for 2024. Well, good, but 2024 is over now. I think they meant to say 2025. That's one of the seasonal things that I referred to earlier, that if January is positive, then things tend to do well for the rest, excuse me, for the rest of the year. We see, according to Carson, so the Stock Traders Almanac will also be coming out with this as well, but their return is 16.8%, where if we have a negative January, then we tend to be negative for the whole year. So we got 1 day left. Unless we see some major crash, it looks like we're going to have a positive January. And then the current combination of macro conditions, that's big picture instead of micro, which means like you're looking inside to a company or inside the economy. It has historically been supportive of risk assets. Okay. Risk assets are stocks. So it just means that when conditions are looking good, the stock market is a good place to be. All right. And I'll probably show this chart in the intermarket analysis video over the weekend. This is a forward-looking price to earnings ratio, and then compares it. Well, they take tech out here, and then it goes across the rest of the world, which shows what we've seen now for the last numerous years, that the US is expensive. We use a 10, 15, 20 scale to look at the PE ratio. I don't use it as a timing mechanism. I know some people do. Well, if you do use it as a timing mechanism, you've missed out on a number of years of really good returns. But when we get above that 20 level and we're at 22.8, okay, we're expensive. But does that necessarily mean everything's going to reverse and come back down to the point where we get under 20? Because to change this number to get back under 20, earnings have to go up, price has to go down, or a combination of the two. And we haven't been in that kind of an environment. Earnings are continuing to go up, but they're slowing down a little bit. Price keeps going up, which keeps this ratio pretty high. And we're just more expensive when you compare it to other markets in the world. All right. Returns in equity markets led by the US have been unusually strong over the last couple of years, and particularly since October 2023. Well, we bottomed in October 2022, and then we had a pretty severe 10% decline in that started in the summer of 2023 and then bottomed in October 2023. And so that's where they're measuring from here. And it just shows that we've been really going up strong here. When you base this around historically what has happened, going back to 1928. And then Magnificent Seven profit growth is slowing. It's still positive, and it's still stinking good. I mean, you look at this, we're up over 20%, but it's not 40, 50% like it was before. So yeah, it's coming down, and so that might slow some of these stocks down a little bit here, but it's still really, really good. I mean, the company looks for what, 6, 7, 8% consistent growth over a period of time. That's considered to be really good. All right. Few stocks are outperforming the S&P 500. This is longer term, going back to 1990. And we've known this. I bring this up quite often. It's the mega caps, it's the NASDAQ 100, and then I talk about the rest of the S&P 500, the Professor and Marianne of the index, the rest, if you're a Gilligan's Island fan. We're quite low there. It's a few stocks that have really been driving things in the bigger picture. That's why we focus on them. And market breadth is weak right now. We're seeing this coming down as far as S&P 500. This is longer term. We're looking good shorter term on the daily charts, but this is going all the way back to 2006. But in the bigger picture, it this also goes into that scenario that it's a few stocks that have really been driving the indexes higher. And then this is a rainbow spaghetti here. And if you want to take this, these are Microsoft, Oracle, Cisco, Walmart, Exxon, Pfizer, IBM, Citigroup, GE, and Intel. And this is the net income tracked through to 2025. And they baseline it back to 100, and then their earnings come out and all. So you might want to pause this and look at it if these are any stocks that you are interested in or you actually own. All right, didn't really spend much time on Twitter these days. So here's the intraday chart showing how we had a higher open and we got above R1 and we just kind of stopped and then came back down below R1, got down a little bit below the daily pivot and the unchanged level, which, as I said, were right on top of each other. But then we found some support up off of that, got back up to R1, which acted as resistance, retraced a little bit, and then we're able to break on through to the other side here with R1. And we didn't quite get up to R2. This is when President Trump was starting to make the comments about the tariffs. And I watched this going, oh my gosh, what's going on? We came all the way back down just about to the daily pivot and the unchanged level, but then we're able to quickly bounce back up off of that and still close up over 0.5%. All right, so intraday, we are up in the initial overnight session here, and we were looking pretty good in the pre-market session before Thursday. And then here's all the gyration that happened intraday. We're looking good here. Intraday, the blue line is above the red line. Growth is going up. Value is doing okay, but not really up all that strong. So this is what we want to see in a more positive environment. The blue line above the red line and improving here with our growth to value ratio intraday for the S&P, where and I might bump this out to 3 months here because I want to include the end of November. That's when we bottomed and growth was really starting to outperform value, and then we leveled off. Well, with the big down day on Monday, we really dropped down here, but we're starting to make a comeback right now. So the end of day charts, growth was up, value was up, but a lot less. They were about even with mid caps growth being up just a little bit more, and growth was up more for small caps. So all green across the board. And if you're not used to this chart, I focus on the left column, which is value, the right column, which is growth. The middle, these are the corresponding ETFs. Like up on top, this would be the SPY right here. All right, so then we look at some end of day charts with the growth to value ratio coming down a little bit, but still positive. Mid cap growth actually advanced and looking positive there. The one that I focus on the most, S&P growth to value, going back up, still in a longer term uptrend, and showing not really much of an improvement here. We look at a growth ETF and a value ETF, and we're coming back down a little bit. Even though growth had a good day, when we look at these two ETFs, this one actually went down a little bit. The discretionary to staples ratio at the bottom, still looking pretty strong. That's been one of the stronger areas of the market. Large cap growth up 0.25%, still above its 50-day moving average. And the condition of the trend, we're still going down. This is intermediate term here. The ADX is going down below its moving average because we're not trending right now, but we are positive with the green line going up slightly and the red line going down. This is short term where we're looking at the green line above the red line. We could be turning up a little bit here. We're flattening out in the short term. We need to see this turn back up, get above the moving average. That means something is strengthening, and then get back above 20, and that would be now we're trending. We're not there yet. And there's been a few false starts along the way here so far in 2025, the latter half of January. At some point, the hope is that we'll get back into a more measurable trending environment. And we were above average with volume, even though it did drop down slightly. We declined with the VIX on a closing basis as well as the bar chart. The VIX of the VIX did decline as well, and that's usually what we see there. Coming back up a little bit with the MACD, but the momentum overall for the VIX continues to be down, which is positive. Coming down, but still in the red area with the skew index. The market is still anticipating some kind of a big move, but we've been up in this red area now for quite a while. We tick down with this fear gauge, and we tick down with the other fear gauge here. So we're seeing some confirmation of fear coming out of the market. And this comes out every week. This is the American Association of Individual Investors. And just I belong to this and have for decades. But we are individual investors. If you're listening to this video, you are an individual investor. And so this group here, it's coming down just a little bit from the latest reading. And the 50 period moving average is also rolling over as folks are becoming a little bit more pessimistic about the market. And then the daily chart of the equity put call ratio, we did decline. And we're barely, it's really hard to see. Get the magnifying glass out here. We were going up, and now we just ticked down slightly with our 5-day chart. And when we're below this red line, that's the green line on this chart, we're getting very low readings with this. We could go lower than where we're at now, but this has been really choppy as we've not been trending much lately. And even though it looks like we're going up, if you look at the top, we were down here with the 10-day equity put call ratio. And still underneath the band with the volatility risk premium, so not a lot of fear coming into the market by this measure either. Showing some improvement with the advanced decline line based on price and volume, and we're still above these moving averages. That's still positive. And we ticked back up just a little bit. This was one of the weakness signs that I just wanted to keep an eye on after Wednesday. We had a very high reading here and then we dropped down. Well, we ticked back up a little bit and we're just a little bit extreme here. We're slightly above, and I have to put on my glasses to see this number here. We're at 99.7. So when we get to 100, that's when it's considered to be extreme. And new highs, new lows, this is internally measuring how the S&P is doing. Really looking nice with the new highs. Saw a bit of an expansion of the new lows. Still going up, but rolling over a little bit here with the 5-day. Still going up with the 10-day. This is showing internal strength. Now, this is showing strength too. This is a smart money indicator because it takes price and volume into account. We're getting kind of far away from the moving average, not measured by the boom indicator. That's what this indicator is supposed to measure, is how far away we are. And you can see that this is very wrong right now. So we just kind of have to eyeball this. It's positive, but you can see other times when we get far away from this moving average, we have a tendency to come back. Improving slightly with our advanced decline ratio, both short term, that's the blue line, and intermediate term, that's the red line. We never did drop below zero since we crossed back above zero, but a bit of an improvement there. And this is another smart money indicator, the chicken money flow. The histogram is going up and the red line is going up. That's showing an improvement. And this is not necessarily extreme. It's given us much higher readings in the past. But our third smart money indicator is starting to get more extreme, the Chaikin oscillator. We're above the red line. That's when we start to watch this a little more closely. If we get above the green line, then we're going to be really watching this closely because then it's getting quite extreme. But you can see, like at the end of 2023, we got a much higher reading than where we're at now. The vortex is showing some improvement here. This was a little bit of a concern after Wednesday. Even though the green line was above the red line, we were going down with the green line. Well, now we're going back up with the green line. Cumulative advanced decline line for the S&P based on price, not much of a change, slight improvement there. Also, a bit more of an improvement here based on volume. This is longer term positive and has been slowly improving after we really dropped down to a low level. We're just inching our way back here. If we get above this green line, that's showing good longer term momentum. And this measures the 10-day average of the highs and lows for the S&P. And then we compare the S&P with the NYSE advanced decline line, both going up. The red line, even though they're on different scales, is below the bar chart. When they're more in tandem with each other, we'll see the lines pretty much on top of each other. And then the cumulative advanced decline line for the NYSE, really looking solid right now and improving with our regular NYSE advanced decline line, improving not quite as much, but still above the moving average with this other NYSE advanced decline line. Looking at just the common stock going up, and we're actually setting a new high here based on volume. This could be positive when volume is leading price. You can see we're breaking out above this previous high. We have yet to break out above this. Now, you could say, well, that's a negative divergence. They're not setting new highs at the same time. Well, when volume is leading price, that could end up being a positive divergence. Seeing some improvement here with the advanced decline line, with the NYC common stock, the S&P, the mid caps, and even the small caps. So this is more broad market strength that we saw on Thursday. This is another broad market measure looking at a 5-period moving average across the Amex, NASDAQ, and NYSE. We're above zero and continuing to advance here. So that's showing more internal broad market strength. Going back up with the 20 period moving average study. These are stocks inside of the S&P 500. We were a little bit concerned because we were starting to drop down here, but we never got below 70. When we're above 70, that shows good momentum. When we get above 80, now it might mean we're getting a little out of hand to the upside. So we're going up and looking better here. This is the actual study where I have on the previous chart, I have the 80 level marked. On this chart, I have the 70 level marked. And you can see that when we came up here, we'd set a higher low and then another higher low, and then saw a nice little upward move here. And then what has happened in the past when something like that happened doesn't mean we go straight up, but it usually means good things for the SPY going forward. Stocks above the 50 period moving averages bounced back up after it had decline after Wednesday. The 100 period moving average study improved, as did the 200 period moving average study. So we're seeing more broad participation of stocks in the S&P 500. We were above average with volume. It's really hard to see this with the new pivot points being drawn in here for February. And that's what I like about pivot points. They're here before the month even starts. These levels are set. And these levels, you can go back. The dashed lines are still here. Go back and see when this marked a resistance level or a support level. Yeah, that's why I update them every day on the YouTube community tab, both an intraday chart and a daily chart. Saw some improvement here with the 20, 50, and 200 period moving average study on the S&P. Going back up, but not extreme right now with the Stochc RSI because we're not trending right now. Where the Williams percent R did tick back up and is looking a little bit extreme right now. But in a good solid environment, we can camp out at this level for a long time. The CCI 14 is showing some improvement, but not extreme, as is the CCI 20. And going back up in the short term with the stochastics, that's looking extreme, turning back up and just barely extreme in the intermediate term, rolling over a bit here with our longer term stochastic, but still extreme positive there. The force index is above zero and improved, so that's positive that way. The condition of the short-term trend, based on 20 periods, the lines are still going up. We're kind of camping out in between the lines right now. But as long as these lines are still going up, that is more positive. And then the simple and exponential moving averages based on 20 periods. See how that provided support last Monday? And we've been going up ever since then. And we're above the midpoint, still in the +1 channel with our standard deviations chart. It would show more solid momentum if we got up into the +2, but then it might mean we're going a little fast if we get into the +3 channel. Intermediate term, balance of power going up. That's positive. Still a little bit confused here with the go, no go. It had a dark blue bar. Now they're lighter blue, even though the lines are going up. So it's positive, but when this type of indicator turns to dark blue, that's when it's the most positive. Still looking good here with our highest high value chart. We're not back up to the blue line, but we are above the midpoint, and the midpoint's going up. Now we're starting to get to that point with the TTM squeeze where we might be getting a little extreme. We're not quite there yet. Now I put the black line on here just as a reference point. And when we start getting close to one of these black lines, then I bring up the longer term chart just to give it a little bit more perspective. We're still just a little bit below it here. If we go above it, that might mean that we're getting a little overextended as far as the TTM squeeze is concerned. We're still above zero with the ease of movement. That's positive. The Arun has gone to sleep. It's enjoying the Spring Festival in China and on vacation right now. But it continues to be positive and is above zero with the oscillator. Going back up with the S&P McClellan oscillator, we were a little bit concerned as we were seeing this decline. Having this go back up just shows that there's good momentum right now, and we're still above zero. So when this is above zero, we're going up with the summation index based on price. We were slowing down based on volume. We kicked it back into gear on Thursday down below. And I point this out from time to time. The top chart here, the summation index based on price and the summation index based on volume, these are two completely different indicators. I just plot them on the same chart. The NYSE McClellan oscillator going back up after it had been declining. Since it's above zero, whoops. Okay, where is the, I guess we'll hit that at some point here. This is one of the things that could potentially be turning more positive. We're finally, after almost a week, starting to turn back up with the Swenlin trading oscillator based on price. But we're still going down based on volume. So we're seeing a bit of a divergence here. It could be a positive divergence if volume eventually turns and goes up. And then momentum is still positive with the PMO. We're going up based on price and volume. The PMO studies are going back up now with the PMOs that are rising, flattening out, but still extreme with the buy signals and still going up with the PMOs above zero. Here's the summation index for the NYSE going up based on price and volume. Forgot to put that in the right place. We're still neutral though with the Elder's Impulse system for the S&P. We're positive with the parabolic SAR since the dots are underneath. We're above this green line. That's why I'm saying we're getting extreme here with the slope oscillator. This is a short-term oscillator. And rolling over a bit, but still positive with a MACD. This is more short to somewhat intermediate term. So I plot the short-term oscillators on the top. They're positive. Then three intermediate-term oscillators in the middle, and then two long-term oscillators on the bottom. And these are all still positive. And then another momentum oscillator is the Copic curve. That's positive. The Sean trend meter coming up, just getting about to this red line now, showing good momentum. If we get up into this sickly looking green area, that maybe means that we're going up a little too far, too fast. And we declined a little bit with the ultimate oscillator, but we're still above 50. We went up with the money flow, and that's above 50. Those are both positive. On balance, volume continues to be positive. Looking at the condition of the intermediate term trend, we're a little bit above the green. Okay, I know my colors, I really do. The blue line here, and the lines are going up. If we can stay above this, that would help the intermediate term trend turn more positive. And we're above all the moving averages here, the 20s, 50s, 100s, and 200s. I call it a moving average tree. When we really start looking messy, then it looks like spaghetti. All right, and the RSI intermediate term and short term are above 50 and going up. Those are positive. This is the mass index where we triggered the first criteria going above the red dash line, the second criteria when we went above the blue line, and then the third criteria is when we come back down below the red dash line. This signals that it's thinking there could be a reversal. Not seeing it yet with other charts, but we just want to be aware of this one. Now, we're still working off of a Pring bottom fisher buy signal. This is still going up. And that ended up being a pretty stinking good signal. We got this signal a couple of days before we actually bottomed with price. But then this has also given us some bad signals over the years as well. And we saw an improvement here with the bullish percent index. It was up again. We were a little bit concerned because it dropped after Wednesday. It's ticking back up after Thursday. And not much of a change here with the NYSE bullish percent index, but it's still positive. This is an improvement. The NASDAQ 100 bullish percent index is going back up and is above 50. So all three bullish percent index charts that we look at are positive. Looking at the longer term trend channel here, still dealing and probably will be for quite a while with the upper end of this trend channel. Is that acting as overhead resistance? What's it going to take to really break above that? Or are we going to do like the mass index is saying, turn and then really start to come down from there? We don't know yet. We just want to be armed with information as things play out. We're turning back more positive. We spent a couple of days with the Heiken Ashi chart with doji like formations here where the open and close are about the same. We actually moved back up a little bit. So this is looking more positive now. We never did turn negative with the Keiki chart. It's black and pointing up. We're more positive with the three-line break, and we're also positive with the Renko with some new open blocks put in there. Long term, want to keep an eye on the 150 and 200 period moving average studies. We did tick back up. That's longer term positive. And we're positive across the board on all time frames with all the stock indexes that we follow. We're back to positive with bonds in the short term. Commodities are positive across the board. If they really start moving up, that could be inflationary, and the market might have a concern about that. And even with the dollar going up on Thursday, we're still in a short-term downtrend. And all the sectors ended up being positive. But you notice what was leading? Utilities. Now, the debate goes back and forth. Utilities are usually more defensive. and they usually closely follow what interest rates are doing. But you can also make a case that utilities are a growth area because of electric vehicles, because of AI, because of the need for electricity for all this technology that's being created now. So it's kind of like, okay, all right, but it was the best performing area and it was really strong in 2024. Didn't seem to really matter all that much because it was going up as the S&P was going up. We did see a nice little bounce in real estate. It's just been hammered lately. Healthcare. Now, these three in their traditional definition are more defensive. All right, but they've been getting hammered pretty heavily lately too. Staples is also another defensive area where you have discretionary, that's a growth area. The financials, we want to keep an eye on that. And they were up, but tech and communication, these are the big growth areas too. They actually underperformed, even though all of the 11 sectors ended up being up on Thursday. And so we saw a BPI cross back above 50 with the energy sector. Discretionary had a BPI cross below 50. Excuse me. And then we have the NASDAQ bouncing around. It got above 19.7, then it dropped below 19.6, 19.5. The Dow got back above 45,000. Canada, they're partying it up there. The communications sector, it dropped down below 70. It going above 70 shows good solid momentum. Coming back down, we just want to keep an eye on that one. And we had a bearish MACD crossover um, with the NASDAQ. I want to keep an eye on that one too. So the equal weight still underperforming the weighted version of the S&P, but both were up on Thursday. The Dow was up 0.38%, not back to an all-time high yet, kind of chopping sideways like everything else. Still neutral with the Elders Impulse system looking at the diamonds, which is the ETF for the Dow. The NASDAQ, hard to see because of the new pivot points coming in here, but we're above the 50-day moving average, up 0.25%. Not a gangbuster day. NASDAQ 100 up 0.45%, above its 50-day moving average. And going from negative back to neutral with the Qs. That's the ETF for the NASDAQ 100. And momentum weakening here with the NASDAQ 100 as well, but still positive for the time being. And keeping an eye on the QQQ chart. Notice how we came right down to the 20 period moving average. That was the low that was set on Thursday, and we bounced up from that. So these support levels are holding for the time being. And we're above all the moving averages here, so that's positive. Small caps just cannot get above that stinking 50-day moving average. We closed right on it for the S&P 600 small caps, and we're a little bit below it here with the Russell 2000 small caps. But we switched over to positive with the Elders Impulse system for the small caps. Mid caps were up over 1%, but still haven't taken out this previous high. This pivot point here was acting as overhead resistance. We'll see if it can continue to go up. We are above the 50-day moving average with the mid caps, but we're still neutral with the Elders Impulse system for the mid caps. Financial sector up almost 1%. It's looking pretty solid there. We're keeping an eye on the bank ETF. It's been able to get above its 50-day moving average and so far stay there. The Wilshire was up 0.62%, still above its 50-day moving average. That's a broad market measure, as is the total US stock ETF. It was up 0.6%, not at an all-time high, but showing some broad market strength there. The FANG index was up. Actually, it was down over 1%. That's strange. But still above its 50-day moving average here. And still wondering, is this longer term trend line going to provide support if we come back down to it? It did on Monday. Will it provide support going forward from here? Microsoft, it really dropped off here. They came out with a good earnings report, but of course, buy the rumor, sell the news, dropping below its 200-day moving average. Apple, which reported after Thursday, like I said, last time I checked, it was up about 3%. That's probably changed quite a bit by now. Amazon down over 1%, but still looking solid there. Google was up 2.79%. Doesn't look like it's maybe it's hitting an all-time closing high at the 200 level there. Meta was up 1.5%, setting a new all-time high. Nvidia was up a mere 0.75% after it's been just chopping all around. trying to deal with its 200-day moving average now. And Tesla was up 2.87%, coming in a little bit above its 50-day moving average. Netflix was down 0.5% and has pretty much been chopping sideways this week. Still looking at a little bit of a deterioration between US and world stocks here on a short-term basis and leveling off with the longer-term correlation. We want to keep an eye on semiconductors. That's a huge part of tech, and tech is a huge part of the NASDAQ 100, which is a huge part of the S&P. This stuff kind of all fits together. We came down to the 250-day moving average here, and we so far are bouncing back up off of that. We're wondering if that's going to continue to provide support. Oil still heading further down into the lower 70 range right now. Just keeping an eye on that. That can really react if geopolitical things erupt. The decline is being attributed to President Trump saying, okay, OPEC, Saudi Arabia, make your oil prices lower now. And so oil went down. The dollar is still in an uptrend and did get back up into the 108 range. And here's where we're looking at the 10-year yield, still above the 50-day moving average. And we want to see if that's going to fall under this 45 level, which is 4.5%. And this is the intraday chart that I followed. And notice here, I have a line right here at 4.5%. We opened down below it, but then we quickly went up, and then this is acting possibly as support here. If we can get down and drop below 4.5%. Now, this is just speculation on my part because it was about at 4.5% when stocks started to have some problems with interest rates going up. So we're wondering if we can drop below 4.5%, is that going to give support to stocks if interest rates are going back down? That's kind of the scenario that I'm running through right now. And then we did go up here with the price of the 7 to 10-year bond ETF. Watching this has been a little bit unsettling now. The home construction to 3 to 7-year bond ratio kind of chopping around, but still below the rainbow after it spent a lot of 2024. See, we came down to this 250-day moving average and bounced up off of that. Now we broke down below it. If we go up, is that 250-day moving average going to offer overhead resistance? Keeping an eye on international rates of the 10-year bond, specifically in Japan, to see if that creates a problem similar to what we saw last summer. All right, saw some improvement here with the Qs to S&P with our other growth to value ratios, but we're still not up to the moving average here. We're above the moving average with discretionary to the S&P and kind of not really improving much when we compare large cap growth to large cap value. So the large caps not really improving there, but we are improving with the mid caps, turned down a little bit here with the small caps. All right, so what's our outlook for Friday? When I have them in gold here, that means they've already reported, and that's about 40% of the market cap of the S&P 500. There won't be any reports after the market closes on Friday. I did check that. We're positive right now, but we're not trending. But at least on Thursday's session, the momentum is improving. And we're going to get personal income and spending, PCE prices, and core PC. That's the big one there. And the employment cost index, as well as the Chicago Purchasing Managers Index. And then the geopolitical things that may have an impact on the market. And here is Friday's economic calendar. Here's also Friday with what we had last time. And we'll just have to see how the market takes that information here. We're neutral to negative for January 31st with the Dow and S&P. We're neutral to positive with the NASDAQ, so not much of an edge. A little more negative here going into the last day of the month. And that's what we see here. Even in a post-election year, the green dashed line does show this going down slightly for January 31st. After this video, I'm going to switch this over and just show it in the weekly video. This picks out the whole year. Depending on what metric you use to measure post-election years, this gives you an idea of what the performance is. I guess the takeaway from this is all these lines ultimately are going up to the right after being down in the left part of the chart. And then I switched this around a little bit. We're still in the second half of January for one more trading day. And now let's look out into the first half of February, where We're positive, but it's not one of the stronger parts of the year, and not really performing that way that small cap should be performing right now, at least historically. But they could catch fire at some point and really start to go up because this goes up into March now. But they got some making up to do there, and interest rates are going to need to come down. We're still looking at the positive seasonality according to Tom Bowley's research. So the warning signs, this is about it. And unless you want to put the mass index on there, but I just kind of treat that as a novelty indicator. I'm sure the person who developed that doesn't appreciate it, but it's not like they're going to contact me anyway and complain. And if they do, hey, we'll have a good conversation. But the Swenlin trading oscillator, it's turning up, but it's diverging. We're starting to go back up based on price. We're still going down based on volume. And that's the negative side right now, where everything else is positive. And we're wondering, are we getting a little extreme here with our smart money indicators? The growth to value ratios, discretionary to staples ratios, those are still strong. They were showing a little bit of weakness after Wednesday. They're showing some improvement after Thursday. And we're going down with the 5 and 10-day equity put call ratios, which when they're going down, that means there's less hedging and we're more positive. The advanced decline lines are improving. The ease of movement is positive. The S&P and NYSE McClellan oscillators and summation indexes are improving after we were a little bit concerned about some weakness coming in there. On a momentum basis, we are positive. The parabolic SAR is positive. The bullish percent indexes for the three indexes that we follow are positive. The vortex is positive. Our moving average studies are improving after Thursday. The money flow and the ultimate oscillator are positive. The financial sector is positive. And we're showing some weakness with the momentum of the NASDAQ 100, but it's still positive. Our conclusion, positive, but we're not trending right now. That's kind of the bigger picture. We're not trending in the short term, but momentum did improve after Thursday. And in the intermediate term, we're a little bit overbought right now. Where you could say we're not trending there either. But there's a few indications right now, especially with our smart money indicators, which you could fit into either short or intermediate term. Long term, we still continue to be positive. Thank you. I really hope you found this helpful. I hope you have a great day on Friday. I'll talk to you many times over the weekend with the weekly videos that I do. So I will talk to you in the next video.